Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. A typical day in the life of a financial advisor calls for back-to-back client meetings, juggling portfolio management, and the consistent desire to improve client relationships. YCharts report and proposal tools could be the missing piece to help you effectively handle these time-consuming tasks. Now more than ever, clients want to hear from their advisors, and with user-friendly templates at your disposal, generating impactful client reports can be easily integrated into your everyday routine, helping you free up time and focus on what matters most, enhancing client interactions and growing AUM. Need to make a clear head-to-head comparison between a client's existing portfolio and your proposed one? Want a seamless way to educate your client and present market trends with minimal effort? Join thousands of users who rely on YCharts to easily answer those questions and much more by leveraging personalized proposal reports to truly showcase your value add. Click the link in the show notes to learn what others are saying about YChart's comprehensive suite of reporting and proposal generation tools. Get 20% off your initial YCharts professional subscription when you start your free YCharts trial. Click the link in the show notes or tell them Meb sent you, for new customers only. T-bills and chill, most of the time. Let's begin. For the first time in a long time, fixed income investors have yield. As of this writing in February 2024, short-term treasuries yield over 5% and long-term treasuries around 4%. Gone are the days of 0% or even negative yielding bonds. How weird was that? Retirees and fixed income investors are rejoicing, many acting like they just won the retirement lottery. For now, we'll ignore the bond declines of 10, 20, or even 50% to get here. Thus, the most popular financial phrase of 2023, let's just T-bills and chill. Now that investors have reawakened to fixed income investing as an asset class, it opens the doors to all types of other bonds. Outside of U.S. government bonds, there's corporate bonds, junk bonds, mortgage-backed bonds, TIPS, foreign bonds, even Bowie bonds. How's an investor supposed to go about choosing between all these various choices available? Many don't, and they simply choose one of two allocations. Either they invest purely in treasuries and money market funds, or they buy a diversified bond strategy like the Bloomberg U.S. Aggregate Bond Index, which is roughly half treasuries, 25% corporate bonds, and 25% mortgage-backed bonds. Generally, as an investor moves away from what everyone considers to be the risk-free asset, T-bills, they accept some additional risk for the additional prospect of return. Two of the most well-known risks are the term premium and the credit premium. The term premium is, for example, instead of investing just in short-term T-bills, and investors could choose to invest in longer maturity treasuries, such as 30-year treasury bonds. Additional compensation is expected for an uncertain future and additional volatility associated with the path of interest rates. Usually, if T-bills yield 5%, then long-term bonds may yield 6 or even 7% in what would be described as an upward sloping yield curve. Now, there's the credit premium, which instead of investing in government bonds, an investor could allocate to corporate bonds issued by companies. These credits can vary in quality from AAA or AAA rated, and there's not so many anymore, all the way down to high-yielding junk bonds. Likewise, an investor could expect additional compensation for the default risk posed by bonds as they move lower down the quality spectrum. Anyways, there's lots of different types of bonds with different features, and generally the riskier they are, the higher the spread these bonds will have to compensate the investor for the additional risk. Investing in bonds in countries like Turkey or Brazil could have yields north of 10 or even 20%. Japan and Switzerland, still about 0. Look, this is all pretty basic investing 101 stuff here, but stay with us for a second. Just like the Buffett and Graham tales about emotional Mr. Market showing up at your door to transact in stocks, the same is true for the bond world too. For example, and these numbers are totally hypothetical for example's sake, but let's just say T-bills yield 5%. And let's say Mr. Market shows up and offers you one day junk bonds also for 5%. Does that make any sense? Probably not. What about at 2%? No way. Now what if he changes his mind, decides to come back tomorrow and offer the same bonds at 8%? Might that be attractive? Probably. How about 15%? More likely. When evaluating an investment, you won't know if it's a potentially good or bad investment without knowing the price. Howard Marks has said it best when he explained, there's no such thing as a good idea or a bad idea in the investing world. It's a good idea at a price, it's a bad idea at another price. Value and price are tied at the hip. Marx has also talked about this as well, saying good investing is not a matter of buying good things, but buying things well. And if you don't know the difference, then you shouldn't be doing much investing. Now, bonds can be just as emotional as stocks. It's always been puzzling to us to buy risky bonds when you're not receiving a margin of safety. If you can chill in T-bills at 5%, why take the risk to buy other bonds yielding less? It doesn't make much sense, but plenty of index investors do just that. Now, could we create a strategy to only invest in riskier bonds when the opportunity was favorable? Devising a strategy here is pretty straightforward. One could let the yield spread between risky bonds versus T-bills dictate how you invest. When the spread is sufficiently wide, invest in risky bonds. When the spread is narrow, sit in T-bills. How wide or narrow should the spread be to change from T-bills to risky bonds or vice versa? It could vary based on how opportunistic an investor wants to be versus how much time they want to spend in the market, along with other considerations such as tracking error, volatility. An investor's portfolio could sit in T-bills and rotate into a 10-year treasury note when the yield was, say, in the top half or 50% of history. You could also run the same strategy, but only when the spread reaches the top third or 20% or top decile, etc. We make sure we don't include a look-forward bias into these models. It's easy to invest in markets when you know the future and how that plays out. So we're only going to use data up to the date examined in these simulations. So let's start with a simple simulation of investing in T-bills or the 10-year treasury note. We use a tactical system that rotates into the 10-year based on the yield spread being in the top half of history. It'll move back into the safety of T-bills when the spread narrows to the bottom half of history. We'll link to this in the show notes, listeners. We provide tables and charts with all sorts of statistics with risk and return metrics for this simple system, but I'll describe it a little bit here. Compared to T-bills, which from 1930 to 2022 did 3.35%, the 10-year had higher returns, higher volatility, and also had a typical Sharpe ratio for most buy and hold investments during the period. A rule of thumb, listeners, buy and hold assets tend to cluster around 0.2 to 0.3 Sharpe ratio over time, which is a risk-adjusted measure of return. So the 10-year did 4.82%, so about 1.5% higher than T-bills. Now the volatility was much higher. T-bills had less than 1% volatility, whereas the 10-year was 6.6%. And T-bills don't have nominal drawdowns. They pay out coupons every month, whereas the 10-year lost about a quarter at one point. So what about our tactical system? Well, the good news is the tactical system both increased returns and lowered volatility and max drawdowns during this period. We don't include transaction costs or slippage in the simulations. Do note, however, this tactical system would have had lower turnover historically. What if an investor decided to do the opposite? Only invest in the 10-year treasury note when the spread was in the bottom half of history in T-bills otherwise. This tactical system would have had lower returns than T-bills, which is a decidedly poor decision. The lesson, when the spread isn't compensating the investor, it doesn't make much sense to take that risk. We can look at different fixed income sectors with different risk and return characteristics and run the same simulation. Here's a simple idea for a strategy that considers investment-grade corporate bonds. Again, you find a slightly higher return for the same tactical system coupled with a little bit lower volatility and similar drawdowns. Unlike today, it was difficult to buy an index of corporate bonds 100 years ago, but the simulation is meant to be instructive. So again, you go from 3.35% for T-bills up to 6.4% for corporate bonds, a little bit higher, 6.79% for the tactical system. The good news is the tactical system had lower volatility than just sitting in corporate bonds. What if you combine the two? Invest in T-bills until corporate bond spreads or 10-year treasury note spreads enter the top half of the respective historical ranges. Same deal. You end up with higher returns, lower volatility, and lower drawdown. Now, there's numerous ways you can run these types of simulations. An investor could run it across the entire series of treasuries, include longer dated bonds such as the 30-year, even other types of U.S. government bonds such as TIPS or agencies. You could run the simulation across all the various levels of credit from highly rated AAAs all the way out to junk. You could even run it across more esoteric type of bonds for most investors with shorter histories, like emerging markets, sovereigns or corporates, mortgage-backed securities, and even high-income equity products like REITs, real estate investment trusts. In our simulations, we found consistent results across all the asset classes, albeit varied in shorter time horizons. But what if you did expand the opportunity set to include more potential investments? In addition to the 10-year Treasury note and corporate bonds, we now include the 30-year Treasury bond, REITs, junk bonds, mortgage-backed bonds, emerging market debt, 10-year TIPS, as the index data becomes available. We then try to equal weight the positions as they're introduced to the portfolio. Initially, this would be 50% each in 10-year and corporate bonds back in 1930s. But as you move forward into the future, once we get to all 8 assets we mentioned, each would have a position size of roughly 12%. So how'd it do? Well, the results largely agree with the academic research on the subject, as well as our previous simulations. You end up with a higher yield, lower volatility, higher Sharpe ratio, and lower drawdown. More importantly, it checks the box for us. Is it simple, and does it make common sense? There's a lot of research on similar topics. One of our favorites is a 2016 paper called Carry. We'll link to it in the show notes that talks about this. For the nerds out there, another way to describe this paper and podcast is a time series carry, meaning you're investing in higher yielding assets than T-bills, but only at certain times or tactically. So as investors rejoice at the opportunity to earn yield once again, many may opt to just hang out in T-bills and chill. And for many, this is a safe and simple choice. Many investors are tempted to seek even higher yields, of course, and the menu of choices is limitless. Now, those that move away from T-bills tend to add other bond categories on a buy and hold basis, and with that, introduce a variety of risks to the portfolio, including the potential for increased volatility and nominal and real drawdowns. Unfortunately, and despite the current drawdown many bond investors are experiencing, some bond categories still have even lower yields than T-bills. The traditional yield curve is still inverted, and many, if not all the assets we talked about so far, do not have a yield spread over T-bills that would place them in the favorable top half of history. If those bonds don't compensate you with a reasonable margin of safety, is that a wise decision to allocate? We don't think it is, but we do think there's a better approach. With this research topic, we attempted to illustrate the effectiveness of implementing a tactical approach to fixed income investing based on the evaluation of yield spreads across a variety of fixed income sectors. We think the power lies in the ability to guide investors over time based on objective rules that have historically shown the ability to earn potentially higher returns than a simple buy and hold approach, but with lower volatility and drawdowns. The simulation helps answer the question, when does it make sense to take on extra risk, and when might it not be prudent? Right now, the system is signaling, as of middle of March, T-bills and chill. But at some point in the future, it will signal a potential green light to take on additional exposures once again. With that said, we think this dynamic approach to fixed income can serve as a core approach for investors looking for a strategy with an emphasis on the safety of Treasury bills, but systematically taking on risk when opportunities and sufficient margins of safety present themselves. Perhaps we'll need to expand the phrase in the coming years too. Let's just T-bills and chill most of the time. Thanks for listening, friends, and good investing.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.
Disclaimer. Cambria Investment Management LP is a registered investment advisor. The information set forth herein is for informational purposes only and does not constitute financial, investment, tax, or legal advice. Please see the appropriate professional advisor for advice specific to your situation. There's no guarantee that a particular investment strategy will be successful. Opinions expressed herein are subject to change at any time. Past performance does not guarantee future results. All investments are subject to risks, including the risk of loss of principal.